Hi guys, my name is Josh and welcome to the channel. On this channel, I like to talk a lot about investing and finance. So in this video, I thought I'd like to keep it simple and perfect for beginners or people who've basically never invested at all in their life, who have zero knowledge about finance, zero knowledge about investing. And in this video, I'll show you how you can begin investing in 2020, not 2014 like my shirt says, but in 2020, okay? In case you couldn't see it. In this video, I'll be talking about how you can start investing with 4 simple steps in 2020, all right? If you've never invested before, then may I suggest having to start investing being one of the goals that you set for 2020, because investing, the earlier you start, the better results you achieve, okay? Because there is a thing called compound interest where your money works for you. Money makes money, right? So when you earn interest in the first year, that interest will also make interest in the following year. And if you compound that money, it basically is a snowball effect. So the earlier you start, the more money that you end up with at the end, okay? And I'll show you the maths later on in the video. But first, you might be asking, Josh, why would I invest? Investing is basically all about making money in your sleep. No one really wants to work till they die. There are also other reasons why you should start investing today. Your interest that you're earning in the bank is close to 0%. If you're invested in term deposits, then you might make 2%. But guess what? Inflation is also averaging 2%. So what this means is that the prices of stuff has gone up, year on year 2%, and you only make 2% on your term deposit. That means that you're no better off saving. And one thing I'd like to note is that not everything has gone up by 2%. Some things have increased by more than 2%. For example, Wicked Wings, and it's been increasing like $1 every year for the past 10 years. Now a bucket of 20-pack Wicked Wings would cost you about $26. 5 years ago, that was maybe at $20. So that's how inflation has been going rampant. What we want to do is to invest our money into stocks, which provide us a higher return than the bank. I made this graph here basically showing what you would get out of this video, okay? A little effort will give you a little return of 2%. So a little effort is basically a term deposit. You will need a little effort to open a term deposit in your bank account, right? Now, if you put in a little more effort, like watching this video, and you would increase your returns from 2% to an average of about 7.5%. That 7.5% is basically the average return of investing in ETFs or index funds. I'll explain that a little bit later. So as you can see, a huge gain in investment returns, but very little effort you put in. Now, if you put in a lot more effort, this is where people who spend a lot of time looking at stocks, they might have a higher return depending on how far they go, but that's not guaranteed because sometimes they lose money. And, sometimes they make money, but on average, they lose more money than they make. And you're earning 7.5%, which means that you're actually better off than most of the people down here who spend a lot of effort and not get a lot of return. So this video basically is to bridge that gap from a little to a little more effort and to increase your returns on average by a whopping 5.5%. Now, without further ado, let's go into the 4 steps. But before we do that, this is only for entertainment purposes only. I'm not an authorized financial advisor, so take what I say with a grain of salt and always do your own research before investing. But I've done some research for you in this video so you can kind of get a first step on what you need to research on, okay? So this video is made for you beginners or anyone who've never started investing at all. Now, step number 1 is to open a brokerage account which has an auto invest function. Auto investing is very important because you don't want to be going into your account every week or every month and investing, buying certain stocks. So make sure you get an account that does all of that for you because you got no time to invest in stock. Now, if you're in New Zealand, which most of my viewers are, then I highly recommend Investnow. For your purposes, Investnow is all you need. But if you want something fancier, try out Sharesies, okay? Sharesies shares basically does the same thing, but you can also buy individual stocks. But in this video, you would not need to buy individual stocks because individual stocks are bad if you want minimal work required, okay? So only get Investnow if you want ETFs. Okay, but if you want to sign up with Sharesies, I have a referral link down below. You can start with $10 when you sign up, and I get 5 if you use the referral link down in the description. It's a great way to show your support to the channel as well. Okay, so sign up with a brokerage account that has an auto invest function. If you're in the United States of America, then I highly suggest M1 Finance. It does the same thing, an auto invest function as well. Okay, be sure to check that out. And signing up with Sharesies and Investnow takes less than 10 minutes really. Okay, I sat down next to a colleague because I wanted the referral link money, so I told him to sign up with Sharesies. He had his driver's license and his IRD number, and he signed up in less than 3 minutes, literally less than 3 minutes. So my referral link expires on the 31st of January, so make sure you use the referral link before that. Okay, step number 2 is to set up an automatic payment from your bank account into your nominated share trading account. So this is a very important thing to do because you can't buy shares without putting money into your account. So you might be asking me, Josh, how much should I put into my account and how often should I put into my account? Well, my answer is that really depends on you. A good place to start is that if you're being paid weekly or monthly, then you might want to deposit in weekly or monthly, okay? So you always want to put money into your account when you get paid, right? So this avoids the incentive for you to look at your bank account and spend your money. Is money coming into your account from your salary and then going out when you invest on the same day? And how much you should put in? Well, that really depends on your financial goals. So I've already done a very quick calculation here. Let's talk a little bit about the assumption I use. So the interest rate that I'm using is 5.3%. 5.3% is basically inflation adjusted returns. Okay, so the returns that you're getting, which I'll later talk about, is on average 7.5%. And if we adjust for inflation of 2%, it's about 5.3%. Okay, and if we put that money to grow for 45 years, assuming you start investing at the age of 20, then you need to put in about $5,750 per year, or about $111 per week. So if we adjust for inflation, that would give you a future value of your stocks of about $1 million in today's terms. All right, so if you start at the age of 20, that's $111 per week. If you're starting at the age of 30, that amount almost doubles to about $10,400 a year, or about $200 per week. That's why it's so important to start as soon as you can. If you start at age 40, that gap grows even wider. Remember, 10.4K now turns into 20.1K, or about $387 per week. So that is the magic, the beautiful wonder of compound interest. Okay, money makes money, and the earlier you start, the less work you actually have to do. Okay, so make sure you start as soon as you can. That's step number 2. The third thing you need to do now is to set an investment plan on your brokerage account. So now you're asking me, Josh, what product do I buy? Okay, now there is a magical product, a beautiful thing in the world called an index fund, or more commonly known as ETFs, exchange traded funds. Exchange traded funds are basically a type of financial product that is a basket of stocks. And this basket could be a very big basket that holds thousands of stocks, or it could be a smaller basket with only 50 stocks. These are baskets that basically provide you with the benefit of diversification. Because you want to do minimal effort in investing, you don't want to pick individual stocks because you might pick the wrong stock and all your money goes to zero. But if you spread your money across thousands of different stocks, the chances of all those stocks losing its value is basically very low. And what you want to invest in is a broad-based index fund. This index fund basically tracks a certain market. So some of the examples that you might want to have a look at are the NZX 50 holds the 50 largest stocks in the New Zealand Stock Exchange. The S&P 500 holds 500 very big companies on the US stock exchange. And the Total World Fund is a type of product that holds stocks all around the world. So if you buy that Total World Fund, that is as diversified as it's going to get. Okay, so these three products are something that you might want to have a look at. So the average return of these index funds are about 7 to 8%. So on average, they're about a 7.5% return. And this is an average number that is based on a very long time horizon. So for the NZX 50, we have about 60 years, and on the S&P 500, we have about 100 years of historical data. And what this means is that some years you might actually lose money. But what I can say is that in the long term, the returns are about 7 to 8% per year. So when you have that auto invest function set up, your money will come in from the bank and it will get directly put into these products. So you don't even have to go in each week or each month. It is all done for you automatically. Zero effort required. The fourth step is a very important step. And this is probably the most important step of all steps ever. And this step is to smash the like button right now. But seriously, no, this step is a very important step. And this step is to do nothing. Once you have your automatic payment from your bank to your brokerage account, and you have your brokerage account directly investing into these index funds, you're good to go. You don't want to do anything. And by doing nothing, I mean you don't want to sell your stocks, okay? Remember when I say the average return of these funds are about 7 to 8%. So if you invested in either the S&P 500 or the NZX 50 or the Total World Fund, you might get about 7% returns per year. Now, this is not a guaranteed investment. Some years you might lose 5%, 10%, maybe even 20%. Okay, nothing is guaranteed in stocks. You might lose money at the start. And when you lose money at the start, you don't want to sell your stocks. Don't sell your stocks. Keep buying stocks, okay? Just leave it and forget about it. Don't sell stocks when they go down. Don't stop buying stocks when they go down, okay? In fact, you should continue buying these stocks because you're basically getting the same thing for cheaper, okay? And who doesn't love a bargain, right? So make sure that you consistently and diligently invest. Don't touch your brokerage account. Don't sell anything. Just keep investing. And in the long term, hey, we did the maths. In the long term, you'll be a millionaire, okay? You know, if this were a clickbait title, this will be the man that brought down the entire managed fund industry, okay? But this is not. This is a step-by-step guide for beginners who have never invested in the stock market before. So I hope you enjoyed this video. I hope it provided you with a great place to start researching and to start getting invested, okay? So be sure to like and subscribe for more content like this. Until then, guys, take care.